That means Treasury is going to try and issue and sell $2 trillion worth of Treasury bonds in the next 2 quarters. That's $2 trillion of new borrowing by the federal government to pay our bills. At the start of the year, they were estimating $1.6 trillion for the year, which was an insane number. Now we're talking about $2 trillion in just 2 quarters.
Wait, what? The Treasury is going to issue almost $2 trillion in new bonds in the next 2 quarters. Is this going to crash financial markets? Or more importantly, what is this going to do to crypto markets? Let's find out. If you guys are unfamiliar with the All In podcast, I highly recommend it. David Friedberg, David Sachs, Chamath Palihapitiya, and the world's greatest moderator, Jason Calacanis, get together once a week. These billionaires debate the topics of the day, and I'll leave a link in the description down below if you want to listen to the entire episode. But what I did for you guys is that I took the best chunk out of this one and I made it very digestible. This is what the government's doing right now, guys. I was completely unaware of this. If the economy blows up, it's not good for any of us, including the crypto markets. But let's listen in on this. And as far as I know, Chamath Palihapitiya is the only bestie on this podcast that owns Bitcoin. So you might want to take his perspective.
I was thinking a lot about the fiscal spending problem in the US, and we should talk about the Fitch rating downgrade that happened this week. I've got some data I'd like to share. One thing I was thinking about was how tied the age of Congress is to our fiscal spending problem. If you think about someone who's young, they're going to want to invest for their future and think about the future. If you're someone who's old, you live for the day and you don't think about the future. And I worry so much that the aging of the establishment that makes the decisions about how money is spent creates a psychological barrier
incentive.
Or positioning that's all about giving away all the money today instead of making the right decision to make sure that we have a prosperous tomorrow. And that's why I think so many of these things kind of slip through. If you put a 20-year-old in charge that was well-informed, in charge of some of the fiscal policy, environmental policy, energy policy decisions, defense policy, it would be a very different set of decision-making than someone who's in their 80s.
Inheritance tax.
Yeah.
I mean,
so
pensions.
Anyway, we should talk, you want to talk about the Fitch downgrade? Because I think it's a really important story this week.
Fitch, the rating agency, downgraded the US's long-term debt by 1 notch from AAA to AA+. Only 9 countries have AAA ratings from the top 3 rating agencies, S&P Global, Fitch, and Moody's. Those are Germany, Denmark, Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia. What you can take from that is you got to have a good balance sheet and you have to have high-functioning governments. The highest functioning governments in the world are the Nordics. That's why you see Denmark, Netherlands, Sweden, Norway there. According to NPR, the negative reaction hasn't been as strong as 2011. That was the first time the U.S. was downgraded from AAA to AA+ by the S&P. That also had to do with the debt ceiling. The markets kind of largely shrugged off the Fitch downgrade. Main reasons for the downgrade is obviously higher interest rates, aging population, the debt to GDP ratio, which we've talked about here. But government kept coming up over and over again, and how dysfunctional our government is. And the debt ceiling is one of the key manifestations of that. Your thoughts on this?
I think you can highlight that there are concerns with U.S. fiscal policy that are putting us in decline in our spending spiral, with the U.S. currency reserves, which there are now diversification efforts underway, and I'll talk about this in 1 second. And that doesn't mean that the U.S. isn't the most exceptional place to do engineering and entrepreneurism and have freedom of speech and thought and so on. But there are elements of the US that put things at risk. So let me just point out these 2 charts. If you guys pull the first one up, this is a pretty striking chart, and I think I showed this before. This is federal government interest payments that are being made. We're now up to, $1 trillion. The chart, as you can see, a year has spiked. And by the way, that number is spiking further, and we'll talk about this in 1 second, as a result of rising interest rates and increased fiscal spending. So this is now becoming a pretty sizable part of our budget. And as of now, paying the interest on our debt is a larger capital outlay for the federal government than defense spending. The second chart shows what happened in the last week, which is that 30-year treasuries have been sold off. And as that's happened, treasury yields have climbed. So there's been about a 10% decline in pricing and a concurrent nearly 10% increase. And Bill Ackman, basically said today that he's shorting 30-year treasuries. He thinks we're going to go to 5.5% long-term rates. Currently, the 30-year Treasury is sitting at 4.3. And remember, I told you guys this after this thing I went to a few weeks ago, that there were two prominent economists who shared that they think we're going to be facing long-term rates in the 5 to 7% range, very long-term rates for a very long period of time, that it is a new fiscal regime. And then if you pull up the last link I sent, Nick, this is a report made by the Treasury Borrowing Advisory Committee of the Treasury Department. And I just want to read a couple of quotes from this report. This just came out today, and it was published. It was sent over to the Secretary of the Treasury yesterday. And it said, since the advisory committee convened in May, 2-year Treasury yields are about 100 basis points higher, while 10-year Treasuries have increased by about 40 basis points. The bank holdings of non-mortgage-backed government securities, mainly Treasuries, have actually declined by $146 billion so far this year. So that means banks are selling off their Treasuries. The committee goes on to say, at the same time, Treasury investors have noted the Treasury supply will need to increase to address the rise in public deficits as tax revenues have come in weaker and government spending has increased. Issuance needs will be additionally impacted by the timing of a recession and so on. Then they said, based on the marketable borrowing estimates published on July 31st, Treasury, this is crazy, Treasury currently expects privately held net borrowing of $1.007 trillion in this quarter, with an assumed end of September cash balance of $650. And then they said, we expect another $852 billion of borrowing next quarter. That means Treasury is going to try and issue and sell $2 trillion worth of Treasury bonds in the next 2 quarters. That's $2 trillion of new borrowing by the federal government to pay our bills. At the start of the year, they were estimating $1.6 trillion for the year, which was an insane number. Now we're talking about $2 trillion in just 2 quarters. So rates are climbing. As a result, we need to borrow more. And this is a perfect manifestation of the debt spiral problem that we've talked about multiple times. Our fiscal spending outlay and the rising interest rates combine to create an insurmountable debt spiral that is now manifesting in the fact that we need to sell $2 trillion of treasuries. Nikki Haley, Ron DeSantis, and Mike Pence have all publicly stated on the campaign trail that they're promoting programs to cut Social Security benefits for people that are 30 and 40 years old. And here's the response to that. So they've gone out and they've started saying that. A poll was done. And on that poll, 82% of voters oppose the push to cut Social Security for Americans under 50. 82%. So where is this going to take us? This is what is so scary to me, J-Cal. I'm not an American declinist. I believe in the American system. It benefited me and my family. But I do worry that we find ourselves in a whirlpool that is very hard to get out of because the populace says we don't want to make the cuts that are necessary in order for us to save ourselves. That's what's so scary to me. At the start of the year, the expectation was they were only going to borrow $1.6 trillion for the year. Now we're borrowing $2 trillion in just these 2 quarters.
Let me just state what I think about the downgrade. It's irrelevant. The S&P did it 13 years ago. Fitch is a marginal credit rating agency. They're at a minimum 13 years late. At a maximum, they're just anxiety-ridden, like other people are, who are always screaming that the sky's falling. So that's my first point. The second point, and the more important one, is that none of you who are always freaking out about this understand this conversation about relativism. All of these conversations are relative. You deal with them in absolutes. On a relative basis, Japan's debt to GDP is 270% and growing. On a relative basis, our debt to GDP is half of that. We are the most important economic force in the world. It is going to continue to be the most economic force in the world. And all I see actually on every single monetary basis is every other country struggling more than we are. So my question to all of the Chicken Littles is, what do you do if you're a central government where you have to have foreign reserves? Do you all of a sudden double down on the euro? Do you double down in the yuan, which is basically a proxy for doubling down in the US dollar? What are you supposed to do? And I never get a good answer because on a relative basis, the US will still continue to do well. I think that debt to GDP is a red herring for a lot of people. And I think that the way that people run their personal lives, which should take income to debt into consideration, I don't think applies as much to governments. And I think these things are going to march forward as a group There's not going to be a single G8 country that all of a sudden moves away and starts printing surpluses. It happened almost as an accident, an aberration during the Clinton administration. It'll never happen again. And I think that we shouldn't worry so much because I just don't see an alternative. So give me, instead of telling me how bad this is because you think about your own life and how it would be bad if you had debt to GDP of 100, I get it. As a country, give me the alternative country. But just start with that. Can you answer that question? What is the alternative country?
Yeah, where would you put your wealth if not the dollar?
Well, let me paint a scenario that's not as dire as a collapse of the U.S. dollar as the world's reserve currency. Okay, so on this Fitch
By the
ratings...
way, that's not what I think happens, right? I think this is just purchasing power goes down. That's it. But go ahead, Sachs.
Relative to who? Be specific.
Relative to anyone.
But what does that mean, relative to anyone?
Friedberg is saying that the Treasury is going to have to do another $2 trillion bond offering. And we have $1 trillion plus deficits as far as the eye can see. And we've got entitlement liabilities on the horizon and then a political unwillingness to do anything about it. So the deficits are only going to get bigger and bigger. Now, what does that do? It's supply and demand. When the U.S. Treasury needs to keep issuing more and more bonds, at some point, the demand for those things gets incrementally saturated and they have to offer a higher yield. So what happens? Well, the bond rates go up. And so the 10-year goes up, like Friedberg was saying, from 4.2 to somewhere in the 5 to 7% range. And that doesn't mean the US dollar is not the world's reserve currency. It just means that it gets incrementally harder and more expensive to keep financing our debt. Now, what is the result of that? Well, if I, as an investor, could theoretically get 7% from the US Treasury as the risk-free rate, why would I want to take equity risk and put it in the stock market, which historically has yielded somewhere in the 5 to 7% range? So if I can get my 5 to 7% from a risk-free US government bond, of course I'm going to do that. So the discount rate on equities will go up. That means that the stock market on a relative basis will go down.
Risk capital will go down. There will be less risk capital
will go down, and there'll be way less risk capital available for things like venture capital and private equity, just risk-taking of all kinds.
If U.S. Treasuries, if 30-year Treasuries are all of a sudden at 5.5, if Bill Ackman's right, which he could very well be, the other part of what he's not saying is, what do JGBs look like? What do European bonds look like? You know what they're going to be? They're going to be trading at 300 to 500 basis points above that. It is cataclysmic for the entire world economy. And so we all move in unison. When we suffer, we will suffer less than other countries. And when we win, we will generally win more than other countries. That has typically been true. I suspect it will typically be true. And I don't see anything changing that.
Well, hold on. Let's assume that you're right. And what happens is that let's call it the Western world, and all these governments which are basically mired in debts with a few exceptions. I guess Australia is good, Switzerland's good, but the rest have massive debt to GDP as well. So their bonds have to move up with ours. And so their risk premium has to go up as well. So you're right, in lockstep with the US. But now why wouldn't global growth just slow down across, let's call it this whole Western dollar complex?
Coupled with inflation.
Right.
Which is inevitable.
That's basically what's happened in Japan, right? Is that they have like a 200% debt to GDP, and they've been very active in yield curve control. And so they've controlled the interest rates, but the price of that's been total economic stagflation
which is the
for 2 decades.
Decline.
They have demographic problems as well, but
that's the main issue there is young people there. There's just not a lot of young people there. I mean, the housing is crazy if you just look at it. And I think the United States has a lot of innovation. So we will innovate our way out of it is my belief, which is kind of what we've always done.
So exciting, guys? We can have this conversation with Larry Summers himself at the All-In Summit, September.
Wait, do we have Ray Dalio too?
Angeles. We have Ray Dalio, yeah.
All right, I had 3 key takeaways from that clip. And my first one is that the government is going to continue printing money. They're printing $2 trillion over the next 2 quarters. Guys, you know that's $4 trillion a year. The U.S. government only takes in $2 trillion in tax revenue. So the deficit is going to keep getting bigger. They're going to keep continuing to print more money, which means that assets like crypto, like real estate, and other finite assets are going to go up in value. I'm excited about that because Bitcoin, Ethereum, and all my favorites are going to go up in value as well. Number 2, the credit reporting agencies are crap, like we all know from the 2008 financial crisis. The government is pretty much bankrupt, and we all know that. So get your money out of banks. If you haven't already, take a look at this video that I did a couple of years ago on what the Federal Reserve is and why the banking cartels actually are the worst part of the United States. And most importantly, part 3. Wasn't Back to the Future Part 2 an incredible movie? I mean, when are we going to get hoverboards already? Smash that like button, make sure that you subscribe to the channel, and also to hit that bell notification so that you don't miss any incredible videos just like this. Until the next time, I'll see you on the next video.